So this lecture is basically a baby of previous lecture. In previous lecture, we had a broad categorization, but in this lecture, we're going to zoom in and talk about those underlying assets first. What type of underlying assets we have. For example, we have T-bills, we have equities, common shares, preferred shares, bonds, and then real estate, these underlying assets. And then, based on what underlying asset goes with what and in what proportion, we're going to divide mutual funds into 6 different groups: money market funds, balance fund, fixed income funds, equity funds, commodity funds, alternative managed funds, and so on. Okay, so this lecture is super important and I want your full attention because this builds a very, very good foundation. Let's get it done. Underlying assets and investment fund categories. Don't feel overwhelmed and don't feel confused that, okay, there are how many categorization of mutual funds do we have? No. In the first lecture, we categorized mutual fund based on the structure. We said we have open end and close end, and 99% of mutual funds are open end. Okay, open ended. Just don't worry about the close end mutual funds. Then in the next lecture or previous lecture, we talked about 3 different types of mutual fund based on the underlying asset, but we haven't mentioned each of assets there. We just said there are conventional mutual funds, which underlying assets are normal types of assets. Then we had ETFs and alternative mutual funds. Okay. Actually, this lecture is baby of the previous lecture. Okay. Previous lecture and previous categorization was a broad categorization of mutual funds. Now, in this lecture, we're gonna zoom in. Based on our scenario, let's say you have a client called Mr. John. John asks you, okay, what does the fund manager invest in? Okay, so mutual funds hold different types of investment, also called underlying assets. Okay, so there are 5 different types or main types of underlying assets that mutual fund managers invest in. Okay, there are 5 types. Number 1, cash. What do I mean by that? This cash type of underlying asset includes physical cash. They may even not invest all money. Okay, they put aside some part of the money aside. Also, cash includes short-term notes or treasury bills. Okay, so these are under cash or under. So these 3 types are under cash type of underlying asset. Okay. Um, we have short-term notes and we have treasury bills and just physical cash. Second type of underlying asset is fixed income. So this fixed income includes bonds, preferred shares, and mortgages. Investors may receive interest income and dividend when the mutual fund invests in fixed income. Okay. The third type of underlying asset could be equities. So it includes common shares or income trust and company stocks. Investors profit from capital gain and may receive dividend when the mutual fund invests or includes equities. Okay, capital gain is the main thing here. The fourth type of underlying asset is commodities. It includes gold, oil, wheat, or any other physical assets. Okay. And these are very volatile and very risky type of underlying asset. And number 5 is other assets. So whatever we haven't mentioned and included in the first 4 type of underlying assets includes in the 5th type, which is other assets. This includes real estate, futures, options, and derivatives, okay? And these are vary in risk and return. What's the point of knowing underlying assets? Based on these underlying assets, based on the combination of like what percentage of number one cash and what percentage of two, three, four, five we have in one unit of mutual fund or in a mutual fund, we categorize mutual fund. Okay. We have, you see baskets here. We have one, two, three, four, five, six baskets. So based on what percentage of those uh, top five underlying assets, we're going to categorize mutual fund. Okay. Starting off with money market funds. What's money market funds? Money market funds are those funds that have 90% of the money invested in number one, which is cash underlying asset. Okay. And 5% could be invested in others, number two, three, four, five. So money market funds are 95% invested in number one, which is cash. What can we understand from this? We can understand that money market funds are have low risk and obviously low return, because risk and return have a direct relationship. Why low risk? Because they invest 95% in cash or short-term notes or treasury bills. Treasury bills offer maybe 2% or like cash. Even when you put aside money in cash and don't invest, you don't earn any money, okay? So low risk and low return. This is the first category. Second category or second basket is fixed income funds. So these are different types of mutual funds. Remember, last word of these are funds. So in the first one, we said money market funds. We mean money market mutual funds, okay? In the second one is fixed income funds. We mean fixed income mutual funds. What's the asset allocation in fixed income mutual funds or fixed income funds? 95% in number two, which is fixed income securities, including bond, preferred shares, and mortgages. And 5% in rest in any of one, three, four, five. So, what can we conclude from fixed income funds? Fixed income funds are good for those investors who are looking for stable income. Why? Because when a mutual fund invests in bonds, they receive interest income. Okay, that's why it is good for those who are looking for interest income. Group number three is balanced funds. Balanced funds is mix of number two and number three. Number two is fixed income securities. Number three is equities. For example, the mutual fund invests 50% or 40% in fixed income and 60% in equities. This is balanced. Okay. What can we conclude from balanced mutual funds? These funds are designed for growth with some stability. Okay. So this is good for those investors who like growth, but is still a little bit afraid. Okay. They don't want to aggressively grow. No, they are looking for stability too. It's self-explanatory, balanced. Okay, balance between growth and stability and fixed income. The fourth group of mutual funds is equity mutual funds. I think you can guess that 90% of this mutual fund is consists of group number three, which is equities. So common shares, for example, or income trusts. Okay. And 10% in the rest. 90% in equities and 10% in the rest. What can we conclude from equity funds? So these funds have high risk but high return. Of course, these equity mutual funds are riskier than fixed income funds. Okay, I think you are now understanding and absorbing the material. I hope so. If you have any questions, just feel free to ask in Q&A. Okay. Group number 5, or mutual fund number 5, is commodity mutual funds. What do? They invest mainly in group number 4, which includes gold, oil, wheat, or other physical assets. So, as you can guess, these type of mutual funds are used to hedge against inflation or diversify a portfolio. Okay. And these are too risky mutual funds because you're investing in physical assets like gold. It's not a company. Okay. It's physical asset like gold, oil, wheat. Very, very risky. And last but not least type of mutual funds are alternative mutual funds. We had this group before in the previous lecture. These group invest in private equities or like weird, non-conventional uh, underlying asset like real estate. So for alternative mutual funds, the portfolio manager needs to use complex strategy, um, and needs a professional management, and experienced investors usually invest their money in alternative mutual funds. Okay, let's wrap it up. On the top, you see 5 different underlying assets that each mutual fund could have. And in the bottom, we have 6 different mutual funds. Okay. We had money market funds, which most of that mutual fund invest money in the group number 1, which was cash. We had fixed income funds. Most of the money in the fixed income mutual funds invest in number 2, group number 2, which are bonds. We had balanced. Then we had equity funds, which invest in equities. We had commodity, which invest most of the mutual fund is invest in number 4, commodities. And we had alternative funds, which invest in real estate and other non-conventional uh, asset types. Okay, great. I think we build a good foundation here. Please go take the next quiz. It'll resolve some maybe concerns that you have. And I'll see you in the next lecture.